but some of it feels a little bit like the internet. For those of you who weren't around in the late 90s, early 2000s, when the internet became a thing, there were a lot of people, the dot-com boom, a lot of that busted, but it didn't mean that those people were wrong in their investments. What it meant was they were too early. The impact of what was going to happen with AI.
Love this podcast because it crushes your dreams of getting rich quick.
They actually got me into reading stats for anything.
You're tuned in to the Investing for Beginners podcast.
Led by
Andrew Sather and Dave Ahern.
Step-by-step premium investing guidance for beginners.
Your path to financial freedom starts now.
All right, folks, welcome to Investing for Beginners podcast. Today, Andrew and I are going to have a little fun. We're going to do a 2025 stock market year in review in, I guess, honor of all the Spotify Wrapped that everybody has been seeing over the last few weeks. Side note, that has got to be one of the most brilliant marketing strategies ever. So this is, today we thought we would talk a little bit about the year in review, what happened in the stock market, and as a little special bonus at the end, we are going to reveal some of our Spotify Wrapped numbers from the podcast. So stay tuned for the end for that. So I guess let's start with, how has the market done this year?
Yeah, I think you pulled up some numbers, right?
I did. Yep, I did. According to S&P Dow indices, the S&P 500 has produced an 18.2% return year to date. We are recording today on December 18th, December 18th of 2025. So we're not quite at the end of the year. The Nasdaq was 22.8%. And the Dow was 14.6%. So pretty outstanding numbers for the year so far. A couple other interesting tidbits. This is the third strong consecutive year for equities. And only 10 times in the last 30 years has the S&P returned greater than 20% in back-to-back years. So it doesn't appear like we're going to get three of those, but we're in the ballpark. And it also said that the historical average after such years is a positive 15% the following year. So that's from the Nasdaq. So overall, I think you could say we've had a pretty darn good year in the stock market so far. What would you say?
I would say it hasn't felt that way if you are a consumer, if you are looking at the economy, and if you aren't exposed to AI.
Yeah, totally. It's been an odd year. There's certain pockets, and we'll probably talk a little bit about that going on. There's been pockets where it feels like it's been awesome, and then there's pockets where it's been like this is awful. So kind of to your point about the different companies and whatnot. So I guess there were three kind of main themes, if you will, for this year. Obviously, the one that has dominated everything has been the AI boom and the profitability question, which has kind of popped up in the second half of the year. But the AI boom has certainly dominated what's happened this year.
Yeah, it certainly has. I mean, we've talked multiple times on this show about the headlines that have been very splashy, and it seems like if you don't own NVIDIA stock right now, you're kind of getting left behind.
Yeah, for sure. And to that point, some numbers that I pulled up giving us revenue growth for NVIDIA for the last quarter was 78%. For their quarter one fiscal 2026 year, their revenue was up 69%. And so the data center revenue has grown 66% year over year. And Jensen Huang was quoted as saying that Blackwell sales are off the charts and Cloud's GPUs are sold out. So it appears that NVIDIA is humming along really well. So when you look at numbers like that for the company that is the largest company in the world right now, those are big boy numbers or big girl numbers. So that is something to definitely consider when you're thinking about investing and how that's impacted the stock market returns over the year.
So if you're a investor and you don't have exposure to NVIDIA, do you think now is the time?
I do not personally. I still feel like it's. Yeah, we could argue till the cows come home. How to value the company? It feels overvalued. When I've looked at the numbers from a very superficial standpoint, it feels expensive, and it also optically looks expensive. And then there's also just the history of the stock market tells us that no company can grow. A $4 trillion plus company cannot grow at 78% year over year from now until the end of time. And so at some point when it does normalize, and it will normalize, then it will start to feel like this is really, really overvalued. So that's always been my concern with NVIDIA. I've never doubted that it's an amazing business or that Jensen Huang knows his stuff, but it's always just felt like, for me, it's been the too hard pile, and I'm going to pass.
Yeah. I like that you brought up history, because it is truly, I mean, we've used this term, people have used this term too much lately, but unprecedented. And just the size and scale and percent concentration that NVIDIA makes up of the S&P 500 is not something that's normal. It is very abnormal. And we have had different markets, different companies, different stocks. But to your point, it is hard to, I don't know. I mean, on the one hand, like I look at a company like Apple, they buy back a ton of stock, but they pay a dividend. You're going to get returns, even if the company doesn't become hugely big. But NVIDIA, all the returns need to come from them becoming hugely big. So how hugely big do they get when they're already a monster size? I don't know if there's a good answer for that, but it is a difficult proposition. Let me ask you this: if you are an AI truther or AI maxi, if you really
I haven't
believe
heard that term before, but okay.
If you really think that AI is everything, then do you think NVIDIA is a must-have stock?
Do you really fall into that camp? Then I would probably say yes. If you're more like Andrew and I, where we're a little more skeptical, cynical, maybe not cynical, but more skeptical and a little more, I guess, on the cautious side, then I would say you can get fantastic returns without owning NVIDIA, and you can be involved in the whatever's going to happen with AI now and into the future by owning other parts of the food chain, if you will. There's lots of great companies that you can own that are connected to what's happening with NVIDIA, as well as some of the other hyperscalers, and you can do really well with those. Google is up, 60 or 70% over the last 7 or 8 months. And, it just shows you how much sentiment can change. Microsoft and Meta, and to a certain extent Amazon, were the clear, air quote, clear winners of AI earlier in the year, and Alphabet was going to be the loser, or one of the losers, and now that's kind of flipped. And so I think there's lots of opportunities for sure. I might have said this on the show before, and if I haven't, I think it's probably a good thing to mention. One of the things about AI is there's no question that it's amazing. There's no question that it can do some pretty awesome things. There's also no question that it's not fully developed yet. It's still growing, and it's still learning, and what it can do 2 years from now will amaze us if we look back on it from today. But some of it feels a little bit like the internet. For those of you who weren't around in the late 90s, early 2000s, when the internet became a thing, there were a lot of people, the dot-com boom, a lot of that busted, but it didn't mean that those people were wrong in their investments. What it meant was they were too early. The impact of what was going to happen with AI was actually 5-10 years after the dot-com bust. And so anybody that was investing prior to that was looking at how much the internet could impact society, commerce, the way we do business, all those things, which all came to pass. But people that invested early didn't see those returns because the valuations got so out of whack that they didn't really benefit from being early. And I'm not saying that that's going to happen with AI, but that is one of the lessons that we could potentially learn from history about what happened. Is that will quantum computing, or will the nuclear reactors, will all that stuff be the way that we do these things in 10 years? Maybe, but it also could be that you're just investing too early. And AI could be the same way. I mean, if we all look back in ancient history of 2 years ago and look at what ChatGPT was when it first came out and how revolutionary it was, and you compare it to what it does today, it's night and day. I saw this video on Instagram, and I'll go off my high horse here. I saw a video on Instagram today showing the evolution of a picture of Will Smith eating a piece of cheese pizza and what it was like 2 years ago, then a year ago, and then today. And, the year ago today was quite comical. And the one today looked perfect. It looked like an image of Will Smith eating a piece of cheese pizza. So it was pretty amazing. So I just, my hesitancy to the AI truthers would be, you may not be wrong, but you might be early.
Yeah, well, kind of going to what some of the sectors you were talking about that have done really well in the market this year, a lot of them are, to your point, you can get exposure to the AI trend without needing to own the NVIDIAs or Broadcoms of the world, who may or may not be overvalued because everybody already knows that story. But there are other sectors now that seem to be coming higher because people are putting the pieces together that, okay, if we're accepting AI as a thing that we're going to live with over the long term, there are other companies, not just NVIDIA, who are going to benefit, and those pockets are seeing some growth. So what are some of those that 2025 has shown us?
According to the S&P Dow, the winners so far for the year have been the communication services, technology, kind of a duh, and then energy. So energy is one of the bigger bottlenecks to AI. And so there's been lots of discussion more recently about infrastructure and energy and how we're going to generate enough energy. And I've seen differing reports in the media about how much energy they're estimating we're going to need based on the build outs of all the AI data centers around the country. And those are the big numbers. And it's, kind of across the board, it's about doubling the energy generation we're going to need in the next 4 or 5 years. And so that indicates that there's going to be a lot of money going towards the energy sector and the infrastructure sector. And that's where the market actually saw some biggest returns in that.
And by the way, electric cars haven't gone anywhere. Yes, I know the tax credit to incentivize buying has been phased out, but people are still buying EVs. You can just look outside your window and see that as evidence. So that's definitely going to create demand for energy as well.
Oh yes, absolutely. Yeah, even though maybe the enthusiasm of Tesla and Elon Musk has maybe faded a little bit compared to maybe a year ago or so, it's still easily the leading, car, the EV builder, and they still have a strong presence. And even where I live in Wilmington, North Carolina, I'm seeing more and more Teslas on the road every day. And the hybrids have also had, I believe, a big jump as well in popularity, as well as production of those, including our friends at Ford. They announced recently that they were going to be switching to hybrids, and they were discontinuing their fully electric F-150 model. So, it's definitely the EVs are going to have an impact, and they're going to need more energy too.
I pulled up some numbers just because I was curious. Using finviz.com, a free screener that is available for all of us. There are 10 stocks in the S&P that doubled this year. 4 of them, and this is four of the top five. So Robinhood's here in the mix. They're number four. But we have SanDisk, Western Digital, Seagate, and Micron. These all have a similar theme. What is the theme here?
They are memory. They are tied to the memory industry. The first three I'm not as familiar with, I'll be honest. But Micron I know is heavily involved in the production of memory chips for AI. They work directly with NVIDIA to design chips that the GPUs will use to make the AI magic.
So basically, and this is just me totally taking a layman's idea, kind of, you have like a computer board and then you might have the NVIDIA GPU, but then you also have the Micron chips that have the memory. So each of those kind of play their own role.
Yeah. Yeah. That's exactly right.
Yeah. So SanDisk was a six bagger, basically. It's up 500%. And then the other three are up over 200%. So they all tripled for the year. It goes to show you what kind of returns are available for cyclical companies. Because I thought I remembered not too long ago, everybody was talking about memory being a place where you don't want to be because of overcapacity. Man, the way the pendulum can swing.
Yeah. And really quickly. I remember looking at Micron earlier in the year, and I want to say it was trading for like a 10, 11, 12 PE, something like that, very low. And when you looked at their revenue growth, it was fairly anemic. And so it was like, well, it's kind of why it's probably trading for that. But now, as a 200% return, I believe their PE doubled over the year. So they've had a huge expansion in the multiple. And all of that is being driven by what's happening with the AI demand and what they think is going to happen.
Yeah, crazy times. A couple others that doubled that I thought were interesting. Lam Research, also in the semi space, and then Palantir's randomly in there. Maybe not randomly because they're kind of changing the world, but I thought that's kind of a fun stock to talk about too. And then Warner Brothers Discovery.
Warner Brothers Discovery. Wow, that's interesting. I would not have pegged them as having that big of a return for the year.
Mm-hmm. So you have these huge returning stocks. If you are an investor who's feeling FOMO, you're feeling like, man, I didn't get any of these top 10 stocks. What would you say to somebody like that?
I would say try not to chase the earnings. The hard part about trying to jump on the train, especially when it's going really, really fast, is that if you don't time it right, you're going to get squashed. And so it can be very dangerous to try to jump on the train. So if you're interested in memory, then I would probably suggest that you learn as much as you can about those particular companies and wait, because it will come back. As Andrew said, they are cyclical. They're very cyclical. Memory, if you look at kind of the whole overall semiconductor architecture, if you will, it looks like, from what I've learned, that memory is probably one of the more volatile parts of that business, because it goes in and out of favor as far as overcapacity. So they build too much and their demand slows down. So then they have inventory that they got to sell and move through. And meanwhile, technology keeps evolving. So it's a very, very cyclical industry, far more so than semiconductors, just in general, whether it's CPUs or GPUs. So if you are interested in something like a Micron or a SanDisk, learn as much as you can about the company, because the knowledge will compound, and just wait, because it'll come back to you.
Yeah, that's cool. So how does an investor know when to wait and when to pull the trigger for something super cyclical like memory, home builders, anything like that? That's like very, very wide swings.
I think the way that a simple way is to look at the history of how the company has performed. If you look over time, you will see things like revenue, fluctuate. You'll see margins fluctuate, and you'll see the PE ratio, for example, just as one metric. You'll see that fluctuate from really high, like Micron at 25, to earlier in the year when it was 11 or 12. And so when you see those wide swings, that's going to tell you that these kinds of industries are very cyclical. And there's no particular way that I've discovered to time them, so to speak. But there are several ways that you can kind of not work around it, but at least understand it, is follow the companies that you think are the best in those industries and keep an eye on the trends, and also try to utilize dollar cost averaging as much as you can. If you buy, it's always obviously best to try to buy at the low part of the cycle, but if you can't exactly do that, then if you dollar cost average, and depending on how strong you think the company is, you can also adjust your position sizing as well. So instead of taking a 15% position size, maybe only take 1 or 2% and dollar cost average into it and let the company earn a bigger percentage of your portfolio as it performs better. And those are some ways that I guess I have tried to deal with that. You've dealt with cyclical businesses before. Do you have any thoughts?
Yeah, another way I like to do it. So, for example, with the home builders, and this is something I've kind of ripped from Oswald Damodaran. Damodaran. I don't know how to pronounce it.
I'm not sure. I've heard both.
Okay. So you take most recent revenue, which could have depending on how cyclical the revenue is, that could be a problem on its own. But what you could do is you can take the most recent revenue, and then you look at what's like a 20-year average for operating margin, and then rather than take whatever the operating margin is at today at face value, you take that long-term average and you apply it to the revenue, and that gives you kind of like a 20-year normalized average of what, like an estimate of if profits were somewhere in the middle this year, then how much profit are we talking about? And then based on that, you can back out a very rough value for the company. Like maybe it's not, if it's $3 billion, maybe I'm comfortable saying that 20 billion is reasonable for valuation, but maybe 60 billion is not, because that's so far from the profits. So that's one way. I think like you, like I haven't found a surefire way to do it. I think I've probably tricked myself into thinking I've had a couple good lucky, buys. But to your point, like when you buy a cyclical, it's very important that you're picking the right one, because even something that's cyclical might not get the same. Everybody's going to talk about the winner, so it'll be like, oh yeah, in hindsight, yeah, of course that cyclical would have bounced back. Not always the case that the companies that aren't as good will bounce back like the winners will.
Yeah. But I think that's some great sound advice of how to try to work through investing in cyclical business, because it just the fact of the matter is that a fair amount of what you can invest in the S&P 500 is going to have some element of cyclicality to it, whether it means that a particular industry or sector may go out of favor for a period of time, or others may be favored for a period of time. And that's a form of cyclicality as well, of maybe not the economic variety. Maybe it's more psychological, where people are like, oh, I hate banks, or oh, I hate technology, or oh, I hate healthcare. And everything is, unfollowed or unloved for a period of time, and then it'll come back. Do we want to talk a little bit about maybe some of maybe not necessarily the specific volatility that we saw, but just maybe some of the volatility that we saw and how zooming out kind of does impact your returns?
Yeah, please.
Okay. So, throughout the year, we had several panic attacks, if you will. I call them that because it was very short-lived. There were different times throughout the course of the year where the market would drop Sometimes it was 2 or 3%. Sometimes it was 8 or 9%, or more. But it always recovered. So everybody probably remembers the Liberation Day, when Donald Trump talked about Liberation Day and the announcements of tariffs and the negativity around that. So during that period, the S&P 500 fell for a couple days, and everything was selling off, and everybody was like, "Is this it? Is this the time that the bubble popped?" And then we're looking at an 18% return for the year. So I think and there were several other different, there was a November dip with the concerns about the profitability of AI and whether all this, so-called circular spending for the AIs with with OpenAI and with all the hyperscalers and NVIDIA and all these companies making deals with each other and how all that's going to flow. There's a lot of concern about whether they're overspending, and that caused some of these companies, including NVIDIA, to dip. But we're still at an 18% return for the year. And for those of you unfamiliar with the history of the stock market, 18% is well above historical returns. If you include dividends over the last 100 years, you're looking at anywhere from 8 to 10%, depending on which source you look at for historical returns. So we're almost doubling that this year, and we're considering it air quote down year. So expectations are a little high right now, shall we say. So I think when I talk about some of these volatility events throughout the year, the reason why I point these out is because I want you to, when you experience it, how to think about it mentally. Like, yes, this is part of the game. This is part, it's not, it's a feature. It's not a bug. This is normal. And for the market to crash, air quote, crash 2 or 3% in a day is really, much ado about nothing. And so when you are investing, this is why we encourage people to be long-term investors, is because this kind of stuff happens regularly, normally, and it's just all part of the gig. And when you zoom back out and look at it over a course of the year, 18% is pretty awesome. When you look at it for the week that Liberation Day was freaking everybody out, it looks like the sky is falling. So when you're experiencing one of those sky is falling moments, try to lean back in your chair a little bit and maybe push the computer a little farther to the edge of your desk and see that, yeah, okay, it actually looks okay for the, for the month, the year. I shouldn't really be freaking out about this. If you got long story short, long story longer, if you bought a really good company and you bought it at a decent price, then Liberation Day in the long run doesn't make any difference. So, that's kind of what I wanted to bring up.
Yeah, you think like having the right expectation plays into being able to handle that volatility?
Oh yeah, absolutely. If you expect, I saw on Twitter today, somebody was bringing back, I think it was the TikTok investors. It was a young couple that, their investing philosophy was, yeah, I buy it when it's down here and I just watch it go up to the right. Like, as it keeps going up, that's how I invest, kind of thing. And for people that think that that's what the stock market always does, it doesn't. And unfortunately it doesn't. We will have an actual crash or bear market at some point. I don't know when. It could be tomorrow. It could be 12 years from now. I don't know, but it will happen. And to quote Charlton Heston from Armageddon, it has happened before. It will happen again. I've seen that movie far too many times. Nice. So anyway, when you're thinking about volatility and how to handle these ups and downs, it's part of the game. And expectations should be to return 8 to 10% a year. 18%, 15%, 22%. Those are rock star numbers. I'm not saying you can't achieve them, but that's not normal. And so these kinds of events that we will see in the future are going to be part of the scenery. So just accept it and understand that, hey, if I can get a 10% return, that's awesome. If I can get a 12% return, that's even more awesome. So just, I guess try to reduce the expectations a little bit.
how are you feeling if you have a stock that's down pretty big? And I have at least one of these on the list, so I'm not just gonna pound sand at people who just happen to have a bad pick. So I'm talking about like the Trade Desk down 68%, Fiserv down 67, Lululemon down 43, Chipotle down 37, United Health down 35. Where is your head at if you are an investor in some of these companies, any of these companies?
Yeah, it's a hard place to be. I think the natural reaction for most of us, all of us, myself included, would be to wait till it gets back to even and then sell it, kind of thing. Probably the better way to try to approach it is to do fundamental analysis. Learn as much as you can about the business and understand if something has changed about the business. So, for example, I can't speak to all the companies that you mentioned, but I can certainly speak to Fiserv. Fiserv has gone through a CEO change. They have also gone through a bit of a cultural change at the moment because they were putting all their eggs in one basket, i.e. Argentina, and they were not necessarily lying to investors, but they weren't telling us the whole truth. And they were banking all of their revenue growth on a very volatile country, to say the least, when it comes to their economy and the impacts of inflation and whatnot. And inflation in Argentina has been better, and that has made the numbers for Fiserv look worse because they were elevated because of the inflation. And once inflation started to get under control, then it air quote normalized, and the company didn't really reveal that. And so it made their numbers all of a sudden look terrible. And when they really were kind of terrible before, they just weren't really telling us the whole truth. So that being said, a company like Fiserv may be on the shorter list. Then I don't know much about Lululemon. If you see me dress in real life, you'll understand I am far from a fashionista. So I would be the last person you'd want to ask for fashion advice. But I think with Lululemon, I guess I would try to get to the bottom of one very important thing, and that would be: is their brand still valuable? Do people still value their clothes? And do they still think that they are worth what they pay for them? All I know is that the company has done far better in China than it has in the United States, and the United States is the largest market that it serves. And so I guess I would try to figure out, can they turn that around in the United States? And if they can't, then you got to ask yourself, is this really a place that I want to have my money? I'm not saying it's a loser investment or a bad company, but if you're just looking at the stock price, you're not going to find out anything real fast. And the math, I don't know the math behind the specific numbers here, but I'm just going to throw out exaggerations. But the math behind trying to get back from a 40% return or a 60% return to get to break even is not just 40%. It's greater than that. It's 75, 85%. Don't hold my feet to the specific numbers, but it's more than just getting 40% back. It's greater than that. So how likely is a Fiserv to do that? I don't know. Like how likely is Lululemon to do that? I don't know. So United Health, I would think that the underlying numbers for the business are probably very strong. It's one of the leading insurers out there, despite all the negativity about the company. If you look at the raw numbers, it's a strong business, or it has been in the past when I've looked at it. So again, I guess the long story short, do some fundamental analysis, figure out if something has changed fundamentally about the business. And if it hasn't, then it could just be market sentiment. And then maybe you could do things like maybe reduce some of your exposure to the company. So still own a piece of the business, but maybe instead of 4%, you sell it down to 3%. So it's not as big of a part of your return. And if the company starts to turn around, you can always invest more because you would be investing from a lower base. So those are some things that you can try. That's some of the stuff that I've kind of looked at as well. I'd be curious your thoughts.
I mean, I have nothing much to add there, but you did dance around Chipotle, and I'm not going to let you get away with that. We are all capitalists here, so don't worry about stepping on toes. But what are your thoughts about Chipotle right now? I know there's people in the audience who definitely have shares in Chipotle.
Yeah. Chipotle is a company that I need to do some more work on, and that is going to be the plan early next year, i.e., in January. I don't think it's a got to get rid of this immediate sell now, because it's down. Oh, it's down some. I think there needs to be some analysis of what's going on with the business. They've had a management change recently, and they've also had some challenges over the last year or two. And so I think there's some analysis that needs to be done to figure out if they can right the ship. A couple of my biggest concerns, and these are more just based on my restaurant experience, is some of the concerns are location. This is a little bit of an older business. Some of their locations are probably 10, 15 years old. And as those age, the traffic to those areas will age as well. We've all seen throughout wherever we live, we've all seen malls that have gone out of business, or different areas of town that used to be the hot spot 10, 15 years later, they're not anymore. And traffic slows down. And that obviously is going to impact a restaurant. They can't just pick it up and, move it to the hot new side of town just because there's a little more involved in that. So that is something that I have thought about and worried about with Chipotle. And then also there's just the market sentiment, or the consumer sentiment about the quality of the food, the customer service, and the amount of food that they're serving that have been concerns with the public. And those have been public on social media. And so that is something that I'm concerned about as well. So those are two of the things that I'm going to be looking into. But as of right now, I'm not planning on buying more. I'm also not planning on selling any of the shares that I own at this point. But I want to do more research to figure out, what's going on before I make a decision.
Yeah, I love that approach. I think there's a lot of wisdom there. And I think there's a lot of things that investors can learn from that is you don't let the market dictate how you're gonna manage your money. Hopefully you're not buying stocks that could go bankrupt tomorrow. If that's the case, there are no real crises or emergencies. Business, yes, things can change quickly, but also they take a while. I'm sure there is some great Greek philosopher, Roman quote, whatever, about how long it takes a building to topple or something. I'm not the guy to ask for a quote like that, but it's something you can take your time. And I think separating yourself from the emotions of the market, because if you're going to keep reacting to market volatility as an investor, you're going to be constantly chasing your tail, and you're never going to make good long-term decisions that way if you never have the time or the space to dictate how you spend your research time. So I think that's something that a lot of investors out there can learn, especially if you're newer, that if you tell the market how you want things to go, you don't let the market dictate your actions, you'll probably get better results doing that, because then you're not going to be chasing what the market does at any given point in time, or at least as much as you can.
Right. Yeah. Great advice. Fantastic. So maybe we could kind of wrap up our discussion on the year 2025 with talking about the podcast Wrapped.
Sure, let's do it. This is kind of fun for us to see. I have us pulled up. So this is just for the Spotify audience. I know a lot of y'all are on Apple, and we appreciate you just as much. Spotify audience, we've got 3 million minutes of listening, which is 2,100 69 months and 5 years. So that is truly incredible how much listening is going out there. One of the other things that we thought was fun is audiobooks that y'all are listening to. Number one audiobook was Atomic Habits by James Clear, which Dave and I are massive fans of. And then, of course, One Up on Wall Street was number 4 by Peter Lynch. That's really cool.
Yeah. Yeah. Who else did they listen to besides us?
Number 1 was Taylor Swift, and number 2 was Morgan Wallen. I am a top fan of Morgan Wallen. I won't tell you how high of a percentage I am because that would be embarrassing to me personally. But he's a great musician, and yeah, there are members of my family that sometimes want to be DJ in the car, and that does play a role. I will say that.
Yes.
The other one that was interesting, a bunch of Joe Rogan fans. That was the number one other podcast people listen to on Spotify. So some cool episodes on there. He recently did one with Jensen Huang, and I think Elon was on there again recently. So
yeah,
cool company to be,
associated with. Yeah, for sure. Yeah, I mean, I think it's I know it blows both of us away that people listen to 5 years worth of listening to our show for the year. And we appreciate it from the bottom of our hearts that you take time out of your day to listen to, two guys talk about something that we really like and really enjoy. And we hope that you get some knowledge and some entertainment out of what we're trying to teach here every day. And we love getting to do this, and we love the fact that we are in your ears 5 years at a time. So please keep coming back, and if there's anything you ever want us to talk about, all you have to do is reach out to us, and we'd be more than happy to discuss it on the show. So you can send us any questions you have or any thoughts you have. You can do that at newsletter@einvestingforbeginners.com, or as we just talked about with Spotify, you can leave us comments on the Spotify app, and as well, you can always reach out to us on the socials. So I guess with that, we'll go ahead and wrap up 2025. We will see you next year on 2026. And if we don't talk to you then, have a great holiday season. Have a safe and happy New Year's. And we'll see you in 2026. And with that, all right. All right. Well, with that, I'll go ahead and wrap us up. You guys go out there and invest with a margin of safety. Emphasis on the safety. Have a great week, and we'll talk to you all next year.
We hope you enjoyed this content. 7 Steps to Understanding the Stock Market shows you precisely how to break down the numbers in an engaging and readable way with real-life examples. Get access today at stockmarketpdf.com. Until next time, have a prosperous day. The information contained is for general information and educational purposes only. It is not intended for a substitute for legal, commercial, and/or financial advice from a licensed professional. Review our full disclaimer at einvestingforbeginners.com.